their projects and things they need to look out for. And then we'll have a Q&A session at the end. Thank you, Nikhil. Maybe you can just move to the next slide. Yeah. So before we start the webinar, the main aspects of the webinar, which is IFRS 17, just like to talk briefly about the objectives of the IFRS 17 IFRS Working Party. The Working Party is has been a vibrant working party for the task, the Actuarial Society of Kenya. And the main objectives are to advance the objectives of task in all matters financial reporting, to help train and equip task members and industry stakeholders on matters IFRS reporting, especially those affecting the actuarial bits. You can also, one of the other objectives is to prepare guidance notes to help members when implementing the IFRS 17 and others IFRS standards that are affecting actuarial and reporting. And then to engage stakeholders through conventions, webinars, as you're doing today, and workshops. So just be open for more of these webinars in the year, and also some workshops to help you equip you in terms of how you need to implement the IFRS 17 standard. So thank you very much.
Thanks, David and Nikhil, and good morning, everyone. Gauri Shah, like Nikhil said, I lead the actuarial practice at PwC and have been a very active member and previous chairperson of the IFRS Working Party, sorry. And what I'm going to cover over the next few minutes really is an overview of IFRS 17, which I think most people that have joined, even just looking down the list of participants, people are broadly familiar with that. What is changing under IFRS 17? What a typical high-level implementation plan would be, the main challenges that we are seeing, and also a little bit of a high-level status update on where the industry is from an IFRS 17 implementation perspective. So in terms of IFRS 17, I think everybody will be familiar that this replaces what we have currently, which is IFRS 4. IFRS 4 was always an interim standard, but 20, 30 years down the line, IFRS 17 has finally culminated, and it is effective 1 January 2023, applying to all insurance contracts. And so for our purposes, both life, general insurance companies and reinsurance companies as well. And what it does is, it brings consistency from an accounting model perspective, but also from a measurement model perspective. Currently, and I think, a lot of you will be familiar with this already, IFRS 4 does not stipulate any any requirements from a measurement and accounting perspective. For those of you that are part of wider groups, or even as part of East Africa, you will know that there are certain jurisdictions where we can calculate reserves as a percentage of other numbers. So for example, IBNR is a percentage of outstandings, and there are other jurisdictions, for example in Kenya, where we actually do employ actuarial methods. And what IFRS 17 is aimed at doing is to bring consistency across the board around that. It will also provide us with very useful information about profitability. I'm sure one of the things that you have all heard about in the last few years is some of the big changes that are likely to happen from an IFRS 17 perspective. One is, if you knowingly enter a loss-making contract, you book the loss on day one, the onerous contract test, which I'm sure you've heard of. The other one being, for life insurance companies, what was very typical in terms of booking the profits for long-term contracts at inception, now will completely change, because you recognize the profit as you're released from risk of those contracts. So over the 10, 20, 30 year period, depending on the length of the contract. But it then provides really powerful information about the actual profitability. Yet, of course, it also increases potential variability and volatility within the financial statements. There's also going to be harmonization of the disclosure requirements and increased transparency as a result of that, because the disclosure requirements are quite detailed and do require you to provide both qualitative and quantitative information backing up the numbers and also some of the key assumptions that have gone in as part of preparing the accounts. I think it's just useful to remind ourselves that actually, the underlying contracts are not changing. And so the underlying profitability or the underlying risks or the cash flows are actually not changing. What is really changing is the way in which we measure and we present those numbers. Yeah. So what does that then mean in terms of what are the high level changes that happen from a financial disclosure perspective? And Nikhil, we can move to the next slide here. This is a slide that our working party has used time and again, but it remains very relevant to pull out the key high-level changes. Probably the biggest change is that the line item that we are so used to seeing, the earned premium, what we call the top line in our industry, is now changing to something called insurance revenue, and that revenue, very broadly, only really exists where we have a profitable contract, but also allows for other things. Where there are long-term contracts, it allows for the release in profitability, allows for change in the risk adjustment, which I think you'll also be familiar with from a measurement perspective, and it also allows for all fulfillment cash flows. So for life insurance companies, the concept of allowing for all fulfillment cash flows is not necessarily new. The step up to gross premium valuation has pushed us in that direction. But for general insurance companies, this is this is relatively new territory from a cash flow perspective. Allowing for all cash flows attributable, premiums, claims, expenses, otherwise. The insurance service expense is now where you will allow for the claims incurred and the expenses, and also any onerous contracts. I mentioned briefly, contracts that are knowingly written that are loss making. You actually book those losses on day one. Be it short-term insurance or long-term insurance, typically, we expect the entire market to now apply discounting. And so there is a specific place where you actually unwind and allow for that cost as well, which forms part of the insurance finance cost there, which you can see on the income statement. And there are lots of policy choices that you can make in terms of whether things are represented as part of P&L or whether they go and flow into other comprehensive income. And these are all decisions that you would make as you go through implementation. Perhaps the key one being the changes in the discount rate and whether they flow through P&L or whether they flow through other comprehensive income. Those are just highlighting some of the big changes. When you look deeper, and companies that have worked through this quite a lot will actually see there are lots of changes that happen from a disclosure perspective, which are then fed from changes in processes, measurement models, data, etc. And it cuts across the board. Yeah. So in terms of a typical implementation journey, and Nikhil, we can move on to the next slide here. At a high level, we would expect people to start with what we call a pilot impact assessment or a deep dive. And this is really where you're performing an analysis of sample contracts or sample portfolios and running that all the way through from data to measurement model to disclosures to actually understand what will be the impact for you as your organization. That then truly informs what the implementation plan would be. And from an implementation perspective, here you're looking at what would be the design requirements from a kind of infrastructure perspective, what would be the capability requirements, not just of systems and tools, but also actually of people. And what are the skills that you need to have in place. It would also inform the detailed project plans, the budget that you need to set aside, etc. That then informs, what we would call the detailed design. And this is where in the market, there are a number of tools, a number of vendors that actually do have a suite of tools that help you really accelerate that journey, so long as, the tools that are being offered meet your business needs. And different tools offer different functionality, and each company really needs to sort of think and decide for themselves what would be the most appropriate way in which to approach this. One of the things that we get asked quite often is, should we develop a tool in-house? This is something that I know even David will talk about a little bit later, but it is extremely complicated to actually try and develop something in-house. We expect most people to buy tools available from different vendors. There are one or two insurance companies in Africa that have embarked on developing their tool in-house, but that is also, specific items, not necessarily the entire suite of tools, and with a lot of consultant support. Globally, we do know of some companies that embarked on the journey of developing their own tools, but then have quickly parked that and decided to again go with a vendor-based solution, which they can then tailor to meet their own specific business needs. Yeah. Once you've gone through that process of, identifying what the data requirements are, selecting, what the IFRS 17 infrastructure would be, what tool would support you, etc., you do then go into, all of the policy and methodology options that are offered under IFRS 17. So that is, what is the approach that we want to use for risk adjustment? What is the approach we want to use for discounting? For the short-term writers here, what do we do in terms of premium allocation approach eligibility? And all of those are then built and tested as part of your detailed design phase. That then takes you into parallel runs, so that you actually have comparatives that you can be looking at least for a number of reporting periods, be it quarterly reporting, be it half-year reporting, so that you actually start to get a sense of how the numbers will differ, but also have time to sensitize them internally and make more people aware of what is coming their way. Transition date is 1 January 2022, so you do need the opening balance sheet and the comparative period disclosed as we then go live 1 January 2023. So we've put some sort of indicative timelines of, what that sort of typical implementation plan would look like. But of course, every company will have their own journey, whether individually, whether as part of a group, and what sort of support you need and capacity that you create both internally and externally. I think one of the really important points to also remember is to have regular checkpoints with your external auditor. This is really critical. At the end of the day, the auditor has to sign off on all of your IFRS 17 policy and methodology decisions, and of course on the final set of disclosures as well. And if we draw parallels to IFRS 9, with IFRS 9, there were many instances where there was disagreement with in terms of approach that was used by a company versus what the auditor felt was most appropriate. And actually, as firms implemented, there was a painful year of especially the first reporting year, where the industry had a lot of back and forth from an auditor perspective, consultant perspective, and the actual banks in terms of ironing out these differences. And it was quite a painful process across the board. Now, again, I'm sure many of you have heard IFRS 17 is probably 10 times, multiple times more complex than IFRS 9. IFRS 9 only affected one line item in your financials. IFRS 17 is changing your entire financial statement. And so the early checkpoints with auditor are really, really, really critical. You don't want to be there at implementation with your auditor disagreeing with some of your policy and methodology decisions, or disagreeing with some of the approaches that have been taken, because then it would just be a mad rush to try and comply. So then on the next slide, we just highlight some of the challenges. Some of them I've already spoken to in the previous slide. I mean, I think complexity is a big one. the standard is extremely complex. For anyone that has tried to read it, you can easily get lost, in the hundreds of pages of text that have been put together. And there are still areas of ambiguity where, we expect industry guidance to evolve, but also, local practices will evolve. And we had that with IFRS 9 as well. 3 years after implementation, a lot of that has stabilized, and sort of industry practice has really developed around the areas of ambiguity. And we expect the same with IFRS 17. IFRS 17 talks a lot about materiality thresholds, and this is a key area that if nothing else, you want to start an early conversation with your auditors around that, because they are the ones that will then eventually sign off on that. Really simple example affecting all our general insurers is typically most of our general insurers will have 1 or 2 portfolios that are long-term and don't automatically qualify for the simplified premium allocation approach. The standard requires you to test and confirm that the outputs are not materially different between the general model and the simplified premium allocation model. And if they're not materially different, you can go on and use the premium allocation approach for the portfolios that don't automatically qualify. Now, that materiality threshold has not been defined under IFRS 17, and it's one that you would need to work on internally, but with the input of your auditor, so that you don't have to go back on what is a very key decision for general insurance companies as part of their implementation. Stakeholder management, absolutely key. I think there's not enough that can be said about that. If you're going to get a new set of disclosures, as a result, over time we will get a new set of KPIs that we will be managing our business against. And using a very simple example, if loss-making contracts, you need to book the loss on day 1, does that mean that we will change the way in which underwriters are rewarded? And that is just one element of stakeholder management, let alone just people familiarizing themselves with the new set of disclosures, and all the external stakeholders that you also need to bring on board with this, with this journey. And I think one of the things that we do recognize as an industry is the potential skills gap that we have here. And it's not a skills gap that is unique to Kenya or East Africa. It is a skills gap across the world. And how do we make the most of the resources that we have, both in-house and externally, to ensure that the IFRS 17 is implemented for you as an organization in the most efficient and effective manner. There will be fundamental changes that happen to processes and potentially products. We have seen examples of people changing their legal contractual wording on certain products just to meet some of the requirements from a contract classification perspective, or also from a measurement model perspective. We've also seen instances where people have had to restate their accounts because as part of the IFRS 17 journey, some products were classified either as investment products, but they should have been insurance, or vice versa. And as a result of that, we do expect to see changes to actual products. And in most cases, definitely to processes, the claims process, for example, the actual process, the finance process, etc. They will all need to be revamped to meet the IFRS 17 requirements. Data is a big deal, in every economy. I mean, we complain that we don't have data here, but, I worked in the UK. We work with our South African colleagues quite a lot. Everybody complains that they just don't have data. So we have to work with the challenges that we have here in terms of data. We went through the same journey with IFRS 9. There is certain data that you absolutely must have. And typically we find that data does exist within the organization, but not necessarily captured in a way in which it is used, in a way in which it can be used readily, in terms of manipulation of data, ease of accessing that data, etc. But there is new data that we will all need to capture as well. And so the quicker you start, you can start capturing that information. Where not, you need to make reasonable assumptions, to essentially create the right set of information to feed your IFRS 17 measurement and other models. Inadequate storage is likely to be an issue that a lot of companies face in terms of, where do you put all of this information together? Lots of different things being considered. Some people talk about data warehousing solutions where, it's effectively creating a data warehouse which brings all of that information together in one place from where it can be used. Others also talk about, they perhaps have the right tools in place, but they don't know how to use them. I mean, one comment that we receive consistently from all finance teams of insurance companies is that they have a really good finance platform, but they probably only use it 1-2%. And they think that that extrapolates to the underwriting systems that they have in place as well, in terms of not actually using the system to its best capability. So, all things that need to be addressed as you think about implementation. And then finally, systems. I think systems is a really big component. This is a transformational project and is a really, really big component of supporting you in the ease of your implementation. Companies are likely to have legacy systems that they need to, figure out what to do with it. But at a minimum, you do need to have a robust actuarial measurement model, whether this is in-house or external, is going to be company specific, and you definitely need an IFRS 17 engine, which essentially pulls all of the what we would call top-end data, so your actuarial data, your finance information, your cash flows, etc., and then harnesses those numbers and gives you what you then need at what we would call the back end, which is your financial information, your disclosures, your chart of accounts in the required formats. And then finally, just a really high level stock take on where is the industry. So Nikhil, we can look at that on the next slide. And here we've just, highlighted some of the larger leading players, and these typically tend to be groups that are leading the way in East Africa, or groups that are headquartered outside of Kenya, where a lot of the IFRS 17 infrastructure is largely decided. The approach that they want to take from an implementation perspective, both for measurement models and also from an IFRS tool perspective, is largely decided, or they've had the conversations that they need to, both internally and externally, and they're actually then working through, the policy and methodology decisions and testing them, testing what would be the most appropriate approach for discounting, what would be the most appropriate approach for risk adjustments, so on and so forth. The ones in between, we would say a lot of them have completed at least initial gap analysis and financial impact assessment. In our experience, a lot of the financial impact assessments have not been detailed enough to provide them with the right context from an implementation perspective. And so a number of these companies are revisiting what they need to do from a financial impact assessment perspective, or what we would call a pilot deep dive, really deep diving to understand what are the gaps. But they've also started looking at the infrastructure proposals and, talking to various vendors, various consultants in terms of how best to approach their implementation journey. A lot of the smaller insurers, and these tend to be, the small insurers that are based in country with no real group support, and most, if at all, have done minimal IFRS 17 training. Sometimes there's a board sensitization workshop. Sometimes they've, attended external training on IFRS 17 just to sort of build their knowledge, and are yet to then embark on performing the gap analysis and the financial impact assessment. Okay. I'm going to hand over to Clifford, and he can take us through what ICPAK is doing and is intending to do in supporting IFRS 17. Clifford?
Thank you very much, Gauri, for taking us through that journey of IFRS implementation and what needs to be done. And I know this has been a multi-stakeholder kind of approach in terms of getting to have the right approach of implementing IFRS 17 within our market. And one thing I would want to mention is that as ICPAK, and again for the sake of our delegates, our members who are joining us for this webinar, is the Institute of Certified Public Accountants of Kenya. And we will be looking at the accounting impact of IFRS 17 and also to guide on the accounting aspects of effective implementation of the new standard. And ICPAK is the institution that is mandated to develop and regulate the accountants profession in Kenya. And this has been the mandate that was given to the Institute through the Accountants Act number 15 of 1978. Of course, this has undergone recent amendments through the Finance Act 2018. But again, that is to really strengthen the regulatory role of the Institute. And aside from that, one or rather the other mandates of the Institute include setting and ensuring effective implementation of accounting standards within the Kenyan market. And that not only includes the international accounting standards, but also the newer standards within the IFRS framework, and that includes IFRS 17. And the Institute, therefore, is really keen to see successful implementation of IFRS 17, and we are doing this in collaboration with the other stakeholders, and this include the Actuarial Society of Kenya. We have the Insurance Regulatory Authority, who are the regulators of the industry, as well as the Association of Kenyan Insurers, because they are also interested parties to ensure that we have effective implementation and reporting of any financial related information within the information that is given in the public domain. Maybe you could get to the next slide, Gauri. In terms of the main support areas towards the implementation of IFRS 17, we have contributed to the standard setting process, and this is both locally and internationally. And as you are aware, or you could be aware, ICPAK is a member of the International Federation of Accountants, which is IFAC, and under the International Federation of Accountants, we have several standard setting boards, and one such a board is the International Accounting Standards Board that is charged with the responsibility of developing financial reporting standards. And of course, this is done through the auspices of the International Financial Reporting Standards Foundation that is based in London, and this is the mandate that has been drawn from the International Accounting Standards Board to be able to review and also develop new standards within the accounting space. And having said that, therefore, I do recall indeed the Institute was able to give its comments when there was an exposure draft that was seeking to have amendments to the initial version of the IFRS 17 standard, and most of these were taken very positively. And whenever there is an exposure draft and comments thereto, it means the implementing countries or jurisdictions or member countries give their views on the practical implementation of that standard and any challenges thereof. And having said that, therefore, we have also a very active process of ensuring that we build the capacity of our members through our continuous professional development forum. forums, which I'm referring to as the CPD platforms. And these ones are arranged, and most of them used to happen physically, but because of the pandemic and the effects of the COVID-19, we have resorted to doing quite a number of these virtually through online platforms, similar to the one that we are currently having today. We also have in-house trainings that are specially organized for organizations. From the presentation that Gauri has made, you can see there are still a number of players within our market who need capacity building. They could be requiring support and attention so that they can also keep up with the pace of implementing this new standard or preparing for effective implementation so that the industry is at par in terms of reporting and also adopting and implementing the new IFRS 17 standard. And having said that, again, in conjunction with our other stakeholders, like we did for IFRS 9, we worked with preparers of financial statements. We did work with CPK. We did work with other regulators through a working group, a technical working group that set to develop the IFRS 9 implementation guidance for the market. And this was done to ensure that we have a uniform, standardized, and harmonized way of implementing the then new IFRS 9 standard. We look forward to doing the same, using a similar approach to get a technical guidance that will assist in implementation of IFRS 17 standard. And I think this is the process that we are also working on together with other players to have a working group on IFRS 17 that will assist in coming up with technical guidance that can be used by the market in the implementation of IFRS 17. What are some of the other key interventions as ICPAK, as the institute? What have we done? Again, as I've indicated, there has been active collaboration with the IRA, the regulator. We have the Actuarial Society of Kenya and also the Association of Kenya Insurers and other stakeholders in terms of ensuring that we have a collaborative approach of coming up with a guidance and also guiding the market and ensuring that there is readiness for implementation of the new standard come 1st January 2023. The participation in the technical working group on IFRS 17 implementation, I already mentioned that, and of course, actively participating in sensitization forums that create awareness on the new standard and build the capacity of the preparers of financial statements and other players within the market to ensure that there is proper uptake, effective implementation of IFRS 17 standard. And specifically, we have recently worked jointly again with IRA. About a fortnight ago, we had a 2-day workshop on IFRS 17. And this, again, was very, very crucial in terms of preparing the market and also highlighting some of the areas that might pose challenges when it comes to implementation of the new standard. We have, again, had several in-house interventions with other industry players. I may not list all of them, the companies within our market, and we are actively assisting them in terms of identifying any bottlenecks that there could be when it comes to adoption of the new IFRS 17 standard. Beyond that, I know, again, I would want to welcome the market to a 2-day scheduled webinar, not 2 days. It's 2 sessions on 19th and the 20th of this month, between 4 o'clock and 6 o'clock. We have a webinar on IFRS 17, looking at Module 1 on the 19th and the Module 2 on the 20th. And we'll also have a bit of exposition on what are the expectations when it comes to IFRS 17 implementation within our market. And finally, is to thank the members and also to really appreciate the fact that we have come in good numbers to be able to see what we can do together as we collaborate and as we cooperate together to ensure that we have an effective, successful, and efficient implementation of the new IFRS 17 standard. Thank you very much. Thank you, Gauri. Unless there is anything else you want me to clarify, I would be happy to do so as we progress with the webinar. Thank you. Over to you, Gauri.
Thanks, Cliff, for that. And now I'll just invite Elias, who will also then take us through the role of the IRA in helping the industry implement IFRS 17.
Thank you very much, and the team for organizing this particular call and webinar. I think from IRA's perspective, and ideally, if I just take it a bit back, what is the intention of this particular standard? We know this standard basically establishes principles for recognition, measurement, presentation, and disclosure of insurance contracts. And these particular requirements are ideally designed to help the users of financial statements to better understand the insurer's exposure, profitability, issues such as the financial position, that in a way facilitate us as an insurance industry for comparison with other industries. If you look at from the Insurance Act perspective, Section 54 requires insurance companies to basically provide their financials and also go to an extent of publishing those particular financials within the newspapers of national distribution. That shows you the importance of the financial statements that the companies do prepare for the purposes of meeting first the regulatory requirements, but also meeting the standards as per required by the policyholders or any other persons that might want really to use these particular financial statements. Now, that basically gives us a critical role as an insurance regulator to ensure that our industry is well prepared towards adopting this particular standard. And one of the things that we've initiated is to provide that particular support that is needed from the industry perspective by giving them the necessary training. And we ensure that this is done just to ensure that all the industry pillars are aware of this particular standard. They know the requirements of this standard, and essentially to enable them now to start this particular process. So in terms of the industry preparedness, I know we can report that a couple of companies have already started this particular process. We'll continue to review and check on how the industry continues to prepare itself towards the adoption of this particular standard as at 1st of January 2023, just to ensure that we are not left behind as a country. Another thing that we've been doing, we will continue to see the necessity of offering guidance notes and circulars in relation to this particular standard. We are ideally looking at the existing framework. In this case, I mean the capital and reporting framework that is currently in place, and see how then this particular standard will modify a number of concepts that do underpin our prudential framework, at the same time our capital framework. So one of the key things that we are well aware is that we need to ensure that we take necessary action to ensure that we need, if in case there are some of the adjustments that needs to be done on our capital and reporting framework, then that needs to happen just to ensure that the industry do not face what we call the significant regulatory burden. Because if we don't align some of our prudential frameworks and also the capital and reporting framework, then we might get some departures between the accounting standard and our framework that might result to issues such as dual reporting or dual valuation, issues of actuarial and accounting, and even companies might end up having two reporting systems just to ensure that they do comply with the requirements of IFRS 17 and also some of our requirements. So we'll continue to consult with the industry as we look at the changes that needs to happen both on the reporting frameworks and the capital frameworks, just to ensure that as this particular standard commences, then we've minimized the regulatory burden. So a lot of, I would say, alignment will need to happen, particularly on the statutory reporting templates, just to align to this particular new standard, and that will require us to do a lot of collaborations. that's why we've initiated collaboration with ICPAK to really look at how best we can ensure that these particular burdens are minimized. At the same time, we'll be having discussions with tasks and other stakeholders to ensure that there is ease or adoption of this particular standard. Now, what we want to stress is that there's need to look at this particular standard with a level of keenness from the industry perspective, because the resilience around the capital and reporting framework will be crucial within the company's perspective, and that can only be supported by adopting this particular standard. So you need to ensure that you check on how this particular standard will affect your financials, what changes might occur, just to ensure that in case this particular standard has significant changes in terms of your capital and your reporting framework, then you are aware of that particular change. So what we would recommend is that the industry should continue to keep abreast to these particular changes to ensure that they do understand both the principles that this particular standard brings in place, and to ensure that their performance, in a way, when they are looking at issues of performance, how does this really affect the performance? Just to conclude is that these are processes that we initiated. We will ensure that we provide the necessary support. We'll continue providing the training to the industry players, but also we'll continue collaborating with key players within the sector, just to ensure that as we transition to IFRS 17, then the industry becomes well prepared, and ensure that the number of changes that we make, even within our prudential framework and also capital framework, remains fit for purpose, because that is the most critical component that we must ensure that each and every standard, be it the reporting templates, be it the capital standard, all that remains fit for purpose, with the ability to ensure that financial stability is maintained within the industry. So we want to urge our players to continue taking this process very seriously. You need to ensure that you already you have a team to work on this particular process, and soon we'll be providing some guidance and even require some status reports from the industry players to just indicate the level at which they have taken their processes around adoption of IFRS 17, and even to understand what challenges they might be facing, just to ensure that those particular challenges are well addressed ahead of time. So I want to take it back to Nikhil. Maybe it will be great if we'll be able to run through some questions where necessary. Thank you.
Thanks, Elias, for that insightful piece. And I think now I'll hand it over back to David.
Thank you, Nikhil, and thank you so much, Gauri, for taking us through what the standard really entails, taking us through like a sample implementation plan, and also taking us through some of the challenges and where the industry is at currently. Thank you so much, Clifford, for taking us through what ICPAK support the kind of support ICPAK will be providing to the industry. And then also thank you so much, Elias, for just giving some of those comments from an IRA perspective, what IRA is going to be doing in the near future in terms of implementing the standard, and even just the support it's going to give to the industry. So even just as we conclude, before we open it up for Q&A, I'd like to take you through what ideally, like for me, this would be the takeout for this webinar is, then what next? What's the way forward? And what we've tried to do is just to break it down for the members and also the people who have attended, is how to kickstart the project for those who haven't started, and also for those who started, just how to realign and make things flow well. So the first thing, even as Elias pointed out, is just set up a project team, a team that will involve people from the actuarial side and from the finance side, and also some aspects of IT to help you start engaging internally. And this project team, for example, from an actuarial side, then that's the team that will start trying to build draft models, basic models to understand based on your product portfolio, to understand the standard, looking at how do you flow, how does your data flow from a best estimate liability, how do you calculate your risk adjustment, and how do you do the subsequent measurements, how does information flow. Also, there you need to include internal trainings for your teams, IT, accounting, even companies that have risk teams. They're also very important. You also need to start coming up with policies and procedures for your evaluation for those who've not started. Another key item that has been discussed all through the webinar is stakeholder engagement. Engage with your auditors, with your consulting actuaries. Start with them. Those are the easy targets. Start engaging with them. They have a lot of tools that they can help you. They can help you plan your project plan and all that. As task, we started engaging with IRA through this webinar and ICPAK. In future, we'll start engaging with the CMA and NSE, because remember, IFRS 17 might change how a profit is recognized, and this might affect how our investors see the performance of the insurance industry. So that's one of the key areas we'll be engaging. We'll also be engaging with ACI to help them understand some of the key issues in terms of IFRS 17, and we'll work collaboratively with IRA and ICPAK in whichever capacity they'll want us to help them. Another major item is budgets. You need to discuss your budgets with your senior management and also at a board level, because the standard can be very complex depending on how complex your products are. So, for example, for people who have long-term insurance contracts, this is where most of the budgets will go, because you need an IFRS 17 engine to help you calculate and amortize and roll forward the CSM and the loss components. And also, as you're discussing that, the budget, you also need to discuss implementation approaches. There are companies that have tried to offer IFRS 17 as a service. So do you go with that option? How does it link with your current reporting? Those are some of the things. And then for those who need to go and buy a system, then the budgetary implications are a bit different. Another thing you need to look at is your systems and data. Review your data requirements and your system requirements. And here, one of the key one is Gauri showed you how the financial reporting would be. So have a discussion with your finance teams. Review your chart of accounts and review your reporting frameworks, because new information will be required. Go and look at your actuarial software. Speak to different vendors. Don't be limited to just one or two. Speak to all of them. Look at their capabilities and take one that is relevant for your company. And finally is the people aspect. Assess your resource requirements. So as people start hiring, you might be, if you join the party late, then you might not get the kind of resources you want. So start early, looking at that resource requirement and plan very quickly. Look at change management in terms of reporting. One of the key items here is how do you incentivize, how do you reward your underwriting teams? How do you reward your sales teams? Because now the top line number that you've always been using is not going to be the same, especially for the long-term insurance business. Review your KPIs and bonus computations, because this will affect such things. So in a nutshell, this is how the way forward we are thinking for you guys as we just conclude this webinar. Please feel free to talk to us at task. Reach out to ICPAK, reach out to IRA. They'll be able to help you in terms of how to implement. But mostly reach out to your auditors and your external actuaries to help you come up with a project plan for this. So thank you so much, everyone. I think then Nikhil, I'll hand it over to you for the Q&As and. Nikhil?
Thanks, David. Sorry, I thought I'd lost you there. Thanks, David, for that. And thank you to Elias, Clifford, and Gauri as well for their insightful presentations. So I have already a few questions that some people had sent in before. And I think we can go through those first, and then everyone, you can use the raised hand functionality. And I can request you to unmute yourself to ask your question to one of the presenters if you like. So I'll start off with the first question, which is directed to Elias. And I think, Elias, you've already touched on this as part of your presentation. And the question is, what is the IRA's view of the industry's preparedness? And what guidance and trainings do you intend to be distributing to the industry as we get closer to January 2023?
Thank you, Nikhil, for that. Now, maybe just to again emphasize the importance of this particular exercise, and one of the key things that we want to ensure is that we enable our industry to be at that particular level of preparedness, just for I would say compliance with this particular standard. We might not have liberty to maybe extend the timeline for compliance or in a way defy it. So the only thing that we can do as an industry regulator is to give that support that is necessitated by this particular requirement. Another thing is that we are highly requesting, in case companies need the support for adoption of this, let us get this particular information ahead of time, just to know which areas we might need to even extend support towards adoption of this particular standard. But maybe let me just look at a number of components as I answer this particular question. The first question is, do we have that level of granularity that is required for this particular standard to be achieved? And for instance, we talk about the product reporting, the liability reporting groups. This is something that the industry needs to quickly look at and enhance their areas of in terms of product reporting and get the detailed insights of the profitability of their products and their long-term financial stability. So in the other hand, it will mean that, do they have these particular systems in place? Do they need to enhance their systems? Now, we can only provide guidance in terms of what they need to do, but the stakeholders, or basically the insurance industry or the insurance players, need to quickly look into some of these particular items ahead of time. Now, one of the key things that I usually say is that IRA moving towards a risk-based supervision approach was a blessing, because if we assume that we are still on the compliance-based system, whereby we had a Solvency I type of standard or framework, then it would have been quite a challenge to quickly get ourselves adopting to this particular standard. But let me look at issues around the capital proposals and how the capital proposal, the capital framework might change in terms of this particular standard. And let me look into the general insurance part. Now, from the general insurance capital framework, IRA might propose to retain the majority of the existing requirement for regulatory capital calculation. And if you look at that, you will see that already in terms of how reserves are computed on using this particular framework, you might not really expect an overall change in terms of the approach, in terms of the application of the liability regulatory adjustments, because already this looks at a very progressive, a very risk-related kind of a standard or a framework. So do we expect quite significant changes there? Maybe not. We might just need to look at how then the reporting is aligned. But on the other side, in terms of where our standards are, where our framework is currently at, and looking at where the IFRS 17 is coming from, then I think we wouldn't really expect a big change on that particular side. Now, on the life insurance side, again, we might propose to retain the majority of the existing requirements for the regulatory capital calculation, and we'll be able to outline a number of changes that might come into perspective. So, for instance, we might need to relook at investment account business. How do we project the cash flows? And how will that really compare with what IFRS 17 requires? And these are some of the issues that we might just need to provide some clarifications, just to ensure there is proper visibility in terms of the overall profitability and the risk profiles of these particular businesses that might be written in life insurance. Also, issues around the volatility and how we look at the issues around the liquidity premiums. I think there's some of the guidance that needs to be provided onto that. But again, if you look at the capital standard that currently is in place, it kind of prepares the industry towards adoption of this particular standard because it's highly risk related. It requires companies to recognize that the risks that are exposed to, and that is where, again, IFRS 17 kind of gives a lot of kind of attention towards. So the industry has already started some work. We will now go to an extent of basically trying to see up to what extent that they are prepared, because at time over the last couple of months or years when this standard came to into the picture, we didn't want really companies to report on their level of preparedness. But I think in the next coming months, we should be able now to get a number of reports on where the industry is from individual companies' perspective. So we'll continue doing that just to ensure that all of us walk the journey towards this particular standard. Maybe let me just touch a bit in terms of the reporting. Now, we want the insurance companies to be able to use this particular standard in terms of the accounting policies and the principles around the financial performance. And what we will do in terms of our prescribed reporting basis, will engage again with ICPAK, because I remember when we were bringing the IFRS 4 standard, we worked on a format for reporting, and I think for again what IFRS 17 will present us will require us to come up with a way some of these particular reports are provided. So we'll continue working with these stakeholders, and we'll be able to relay that information to the insurance companies, also to provide their feedback, just to also prepare them towards meeting some of these reporting directions that we'll be giving in the next couple of months. So again, industry is getting prepared, but the next level will be, we will require feedback and reports on the level of preparedness that the industry has undertaken over the last couple of months or years.
All right,
Thank
perfect.
you.
Thanks, Elias. The next question I think is directed to David. So I think in Gauri's slide, David, she talked about different insurers across the world who have been looking at developing in-house solutions or purchasing ready-made solutions and then tailoring them to their requirements. How has your experience been at Britam in terms of either developing a solution in-house or looking at the readily available vendor-based solutions?
Thank you, Nikhil. Even as I answer that, I'll just touch on some aspects of what Elias has just discussed. So in terms of just our learnings from where I work at Britam was we set up a project team more than a year ago, around 2019. And what we were tasked with was just to look at, really try and understand the standard, read the standard through and through, come up with models that will mimic IFRS reporting. And now this is not, we went further, not just doing a draft model for simple products, was just looking at our current products and doing a thorough deep dive of doing that valuation. And I must say it's very complex. IFRS 4 does not compare at all. One is you need to separate your contracts between profitable or onerous, I'd say, and then others that are might fall into either profitable or onerous. So that's one of the major challenges, especially for companies that have long-term insurance products. So the question we found ourselves was asking ourselves was where do we draw that line? And we found that at a certain revenue or at a certain premium level, some contracts are profitable, others would be onerous. So that's one separation. And then you need to go further and break down this into cohorts. So for example, if you start with if your first year of transition, let's say is 2014, and you have a number of products, for us, we found ourselves that we'll have around almost over 500 cohorts. So just that complexity makes you, first of all, just start wondering, how are you going to do this? If you're going to do this in-house, you need a team of actuaries, you need a team of accountants, and then finally need a team of IT developers to help you do this. One, the IT developers will now need to understand the insurance aspects of your products, and then next they'll need to understand IFRS 17. So that's going to be like 6 to 1 year, just trying to understand. So it's going to be very challenging if you're going to do this internally. And I'm sure most of us, when you're thinking internally, you're looking at Excel models. So if you're going to use the Excel models as an internal software, then you'll be faced with a number of challenges. One, you need a very big team of actuaries to do that valuation because of the different cohorts and all that. And then the next thing is, because of the challenges inherent with the Excel models, we'll have a lot of errors, and it's going to take a lot of time. So for us, we've just chosen not to do an in-house development build. We'll be looking at software vendors who've done a lot of the work. Some of the software vendors started work before even the exposure draft was issued. So just to quicken that process, then I would not advise anybody going for an in-house, but for the PAA contracts that will be falling under PAA, then I think people can opt in for an in-house Excel models because it's not very complex, but Gauri mentioned aspects of materiality. So for you to show that if you're done your valuation using another, the general measurement model, would the results be very different from the PAA? Just doing that aspect then can be a bit complex depending on the nature of products you are selling. So that's in a nutshell, I'd say some of the challenges we face. Another big one was just coming up with a budget. Coming up with a budget has taken us very many months to try and convince us, the business, oh, for this project you need a system, and these are some of the cost implications. So those are basically what I'm just trying to say. Start this thing early, set up that project team so that you're able to understand some of these challenges that we are talking about.
Thanks, David. And the next question here, I think, Gauri, this one touches to your slides that you already covered. I see you had presented to us where the industry is at in terms of small, large, medium insurers. And I think this question is just to see, what are you seeing from an East Africa perspective? Does that slide translate across our whole region, or is it just Kenya specific? Yeah.
Sure, thanks, Nikhil. So I think in some ways, yes, it does translate to the regions as well. What I would probably just say is that the regions are perhaps a little bit further behind than where we are. And this is particularly the case where the headquartered company is in Kenya with East Africa presence, because then we actually need the head office and the Kenya entity, which tends to be the larger one, to make substantial progress on their own implementation and then bring the rest of the group along. Where there are entities which are then headquartered outside of East Africa, either in South Africa or in some cases in Europe, those ones have made more progress. But again, if I was to compare, their equivalent counterparts in Kenya have then made substantially more progress compared to what we see in our neighboring regions. Typically, again, Kenya being, the center of excellence for those entities from an East Africa perspective, then relying on, all of the things coming out of group in terms of then localizing them from an East Africa perspective. So yeah, similar story, but I think there's more hand-holding required, and perhaps recognition of the fact that they're further behind.
Amazing. Thank you, Gauri. The next question we have here is for Clifford. Clifford, what we'd like to see is, has ICPAK done, I think you've already mentioned ICPAK working quite closely with TASC, the IRA and ACI. And I think, are you planning any interaction with the KRA on any of the tax implications that may arise during the implementation?
Thank you very much, Nikhil. Yes, indeed, we do have interactions with the key stakeholders, as already alluded to earlier on. And when it comes to interactions with KRA, and I believe this is to do with the tax implication of the new standard, let me mention that indeed, yes, we are taking a step-by-step approach. First is to ensure that the members within our market fully understand the implications and the requirements of IFRS 17, and we will be collecting and collating any views that we get from the market and see what are the pain points when it comes to tax, or what are the implications from a tax perspective that the industry or the market needs to deal with. And then we will have an informed position with which we can involve the KRA, especially from a taxation perspective. And as you realize, the standard comes up even with new terms, the CFM, the insurance contracts, the earned revenues, and all this will have implications in terms of how we approach the taxation from a tax perspective. And so since we know that taxation is based on profits, so indeed we will look at the new requirements of the standard that will in a way twist the way we have always been looking at tax and the taxable profits within the industry. And that will give us a guidance on what basis now do we approach the KRA so that we can harmonize the way KRA is going to look at the taxation, and also how the new standard is going to impact on the market, and how that is going to be reported, and also ensure that our members are well up to date with how they must compute the profits and the taxation requirements for purposes of ensuring that we have no problems with the taxman. And finally, is just to mention that we have recently had the minimum tax debate. And of course, what we did even before the suspension by the High Court of the newly introduced minimum tax, the Professional Standards Committee of ICPAK did extensive research on the implications of minimum tax from an accounting perspective. And just last week that we adopted and approved a paper that was going to give guidance on how we can deal with it from an accounting perspective. But just then we realized that there has been that intervention by the High Court, but of course we are waiting for the outcome, and then we can give guidance to the market and also engage with the KRA on how best we can introduce some of these new aspects that impact on tax. And we will do the same with IFRS 17, but at the right time, again, once we have all the information from the market and the specific challenges, then we can engage with the regulator, with the KRA, the authority. So thank you very much. I think if there is any need for further clarification, then I will be happy to do that. Thank you so much, Nikhil.
Thank you, Clifford. I see, Joseph Virundu, you have your hand up and you've had it up for a while. I don't know if that's a mistake or you have a question for our panelists.
No, thank you, Nikhil. It's not a mistake. It's more of even a comment. So I think Limo tried to talk about the PAA and how you can use Excel models. But in that, he didn't say that if the contracts are onerous, then you need to go back to GMM. And once you go back to GMM, there's added complexity, and that pushes you straight towards using a system rather than Excel models. So I think that was a kind of comment, or I don't know whether it makes sense to you, Limo.
Thanks, Joseph. Thanks, Joseph, for that. I think I mentioned if your contracts are not onerous, you can use PA. But if they're onerous, then the standard requires you to apply GMM. And if the numbers are not materially different, then you can still use PAA. But then recognize a loss component as the difference between your PA value and the GMA value as the loss component. So that's the only areas of simplification you are allowed, and the approach you can take into adopting either PA or GMA. But you're very right. Trying to do a GMA for any contract is quite challenging. So most people would be default to a system at some point.
Okay, yeah, so thanks a lot. I think the general idea is that most probably you're going to need a system.
All right, thank you, Joseph. We have another question here, which either perhaps Elias or Gauri or Clifford, you may be able to answer, is what have you seen other regulators in other jurisdictions doing to support insurance companies? Or what guidance have you seen them circulating to the insurers to help them be prepared for 1st January 2023?
Yeah, thanks, Nikhil. Maybe I can make a broad comment on that, and then invite Elias or Cliff add to that. But generally, I think we should all recognize that the regulator has a really important role in getting the industry ready. And you know, some of the things that we've been talking to Elias about and what he shared in this webinar really speaks to that, which is you know, the level of support that they want to provide to the industry through the trainings and you know, other mechanisms. What we have seen regulators do, and different regulators, I think, depending on their own sort of skills, capacity, size of insurance industry, etc., have done different things. But in general, training is a key component of that. But also then providing a project plan for you know, the industry to push them along. So you know, a gap analysis by a particular point in time, impact assessment as part of that, and then using that information to almost help the industry make certain decisions, especially in areas of ambiguity. And you know, where there are some local nuances to consider. And we've seen some of the African regulators also do that. I think COVID has meant that you know, some of those deadlines were not necessarily adhered to, but we are seeing, you know, some of the regulators in East Africa, but also, you know, when we look further, both in Southwest as well, that there is quite a bit of regulatory driven activity that is now happening. I don't know if Elias or Cliff want to add to that.
Just to mention, I think one of the key things that we will be looking at, we will not try and micromanage how this should be done. We want the industry also to run along and ensure that they get themselves ready. There's an extent that we are going to do in terms of providing training, and I've mentioned that in the next couple of weeks or months we should be able now to get some reports from the industry just to get you guys ready. There's a role that the regulator should take, and let me just look at what is the IRA's objectives. What is the IRA's mandate? And our mandate is very clear. Is looking at the financial safety and the efficiency of our systems, the insurance industry. And if you look at the key primary objectives of this particular standard, the standard will kind of, in a way, provide a high level of financial safety, but also high level financial system stability. And what we intend to do is that we know that there'll be some changes to our prudential standard that will, in a way, support the financial safety that we are talking about. We know that these particular standards have been designed to ensure that there's that consistency. But what we want to do will ensure that these standards do not alter the capital strength of the insurers. So in terms of how the capital strength of an insurance company should be consistent and should not change based on this particular standard, but also in terms of how then the company looks at their financial system, they need to ensure that your financial systems are at a level that will take care of these particular changes. So there are maybe four key things that I would want to mention in terms of the consideration that we are taking. We expect that these changes will improve the long-term efficiency and transparency of products in the way companies look at their products and the way they sell their policies. And one of the key things that we are going to look at is to reduce the regulatory burden of two reporting systems. And that is something that we are going to work to ensure that it's something that we address. The second thing is competition. And these particular changes, in a way, we are not expecting these changes to materially alter competition within the sector in terms of how we recognize cost of implementing the capital and reporting changes that might in a way be higher for maybe small insurers or something like that. So we want to ensure that professionality is taken into consideration, and in terms of the key reporting things that we'll be looking at in terms of the gap analysis, in terms of the level at which your project team has been working on this particular standard. We are going to look at how then that is well adhered to. Issue of neutrality in terms of we might not want to create advantage for particular sector participants, be it public sector entities relative to other market participants. So we want to ensure that this particular standard gives us that ability so that there is no, I would say, attention given to another set of insurers, and we might not provide the same to the other insurers. And that's why when we were conducting the training last 2 days, quite a technical training, we looked at all companies. We provided the same level of I would say support, and also we are just calling upon if any company might be having challenges in terms of the implementation, they can reach out, and we'll be able to see how best we can assist. So one of the key things, and ideally, is something that we will try as much as possible to not encourage, because I know in this industry or in very many industries, people like deadlines, people like timeframes, people like next steps. Just to give you some of, I would say, some assurance, is that yes, we believe that we need to make some timelines, indicative timeframes in terms of integration of this particular standard to our prudential framework. At the same time, look at how these will be set out. That is something that we'll be working on, and soon we'll be providing that information on how, when we expect to get those particular gap analysis reports, how companies are conducting their QISs, the quantitative impact analysis, and all those particular things that are necessitated by this particular requirement, just to get guys now on their footing, because that is maybe how most of companies within this level of jurisdictions are a bit coined. You must have like a time frame and the next steps, and if you don't do it by this time, these are things are likely to happen. But also from the regulatory side, we wanted this particular process also to be owned from the board level, so that it doesn't work out as just a regulatory requirement. Because most of the time, if we make this particular process to become more of a regulatory process, then it will not meet its intended objective. It should be issues that will, ideally, you look at your governance of your systems, the governance levels within a company, how you look at your business processes outside the regulatory framework. The only thing that regulators are supposed to do is to just provide, I would say, assurance, take the work with the industry, and provide clarifications wherever it's needed, just to ensure that we create that balance, not to make it a regulatory process. Because if you turn this particular IFRS 17 to be a regulatory process, then it beats its logic. It should be more of a company process in terms of how they look at their reporting systems and the reporting standards based within this accounting standard.
Thanks, Elias. I guess in the interest of time, we have one more follow-up question. Following what you said, what is the IRA doing to build internal capacity ahead of the insurance companies?
Internal capacity in the companies or in IRA?
In IRA.
Maybe I would want to ask that person, does he believe that there is no internal capacity? let me just confirm that I believe that based on where the IRA is sitting, basically where we are, IRA has rightful resources and capacity to get this happen. So I think we should be more concerned with, if you are a company, get concerned in ensuring that your standards are within place. You already started the process. That's why we are providing that particular support. So the capacity is there within IRA, and in case there are some areas that we might need to increase in terms of the technical capacity, I believe that there are adequate resources to get that in place, and just to ensure that this particular process becomes as seamless as possible.
Oh, great. Thank you, Elias. Now, I look at the attendees. I see there's no one else with their hands up, unless anyone has a dying question they would like to ask our panelists before we conclude this session. Okay, so with no hands up, I can see, yes, Piramal?
Yeah, good afternoon. Actually, I'm from vendor side. Actually, we have clients across the Africa. We have more than 25 plus customer. So our product name is Premia. So as you rightly mentioned, like there is one thread like which you said that auditor has to approve on the development of the tool perspective on the financial statements. I think Gauri Shah mentioned that. So is it required to get it from an Africa region, or is it applicable even if we get it from ICPAK or like Middle East, which will also can be used for Africa?
Maybe Nikhil, I can just really quickly comment on that. Parimal, I think that's a great question. And you know, there are lots of tools available in the market, locally developed and you know, developed in other countries. I think every company needs to make their own assessment from a cost benefit perspective, but also, you know, usability, access to the tool, and you know, the functionality, how it integrates with their own systems, etc. And there's no right or wrong answer there. But I think the point really is that whatever you do, remember it has to go through the auditors for the final sign-off. So it's really important that they are part of that journey and you have regular checkpoints with them. And quite often, you know, the auditors that audit most of the organizations in East Africa are also part of a global network of firms, and will also perhaps be able to advise you on the appropriateness of the tool, how it integrates, because they're likely to have had that experience with other clients. So, you know, part of it is also use your auditors to your advantage to help you move along in the right direction. Not only, you know, the sort of making sure that you have the regular checkpoints with them from a sign-off perspective, but also use them in terms of providing the right guidance. Yeah. Hopefully that answers your question, Parimal.
Yeah, very much. And maybe I'll take another 2 minutes of your time. This ICPAK, the professional support enabling, will they able to give us support to build a system, or I can say that fine tune the developed system? So like mapping of accounting, which is required, as well as the measurement calculations and data elements which are required to capture. So will they able to do so? In such cases, how do I connect you this separately?
Okay, sure. Yeah, maybe you know, happy to have an offline conversation about the
Yes.
specifics of that, but perhaps just more for the broader audience. As you use your auditor, you will be all familiar with, you know, the independence requirements. So there are certain things your auditor can do, certain things they can't do, and every company has their own governance around what they want to use their auditors for as well. So, you know, just bearing that in mind. But happy
Sure.
to answer some of your more specific questions separately. Yeah.
No.
Back to you, Nikhil. Yeah, sorry.
Thank you. No problem. So it will have both three measurements like VFA, BBA, and GMM. All these things we can get. I can maybe in the working group, or I can connect you separately, or the team. You just guide us so that I can be in touch with offline. Or you can connect me muthu.k@ascensio.com.
Sure.
All right, thank you.
Thank you.
We'll see if there's any more hands up.
Nikhil, there's a question from Fantas.
Yep.
I don't know whether you're able to see that.
To what extent? Okay, yeah, I've seen it. Yes. I think this is to IFRS 17. So to what extent do we think the implementation of IFRS 17 will severely impact the balance sheet of companies? And do we think Kenyan insurance companies are capable of taking on the cost implications?
Maybe I can address that, Nikhil. So
sure.
I'll address it in two ways. I'll separate the companies into two groups, the large companies and the smaller companies. For me, I feel that the larger companies are able to take in the cost implications, that the ones we've seen, but it's just on a high level. Mostly, for example, the South African-based companies, they'll be able to get support from, I believe, from their parent companies. The local large companies, I feel, if they're able to negotiate well on the software costs and just resource planning, I think they're able to take this. For the smaller companies, maybe an approach would be to get the IFRS 17 calculation as a service that's being offered by various industry players. And I think if we just start engaging with them, and then also ensuring that, for example, if you're going to get your service from your auditor, looking at what Gauri mentioned about independence, are you able to use the same auditor to do your valuation, and then the same auditor is going to do your quality assurance or your assurance of your financial statement? So those are the things we'd be able to see. But for me, for the smaller companies, it's going to be the cost implications could be high and might not be able to. I'm not so sure whether the board would really be willing to take this up. But also, maybe another way of looking at it from maybe an IRA perspective is, do they push for mergers and acquisitions at this stage? I think that's something that can be discussed going forward.
Thanks, David. I think we've now overrun by about 10 minutes. So unless anyone else has a burning question, I'd like to give maybe David a few minutes to give some closing remarks as the chair of the working party.
So thank you very much, Nikhil, for moderating this session. A special thank you to Gauri, a special thank you to Cliff, a special thank you to Elias for agreeing to be part of this. A special thank you to Task team for organizing this, John and your team. Thank you to the Task leadership, Moses, and the team for giving us this opportunity to guide the industry. And then finally, thank you, everyone. I saw at some point you were around 120 people. I hope that 120 people are going to translate into the standard being understood by your businesses, and we'll see a lot of work in terms of the implementation. And then finally, I just want to really congratulate Elias for confirming that IRA will not be pushing for a dual reporting. If I heard you right, that basically means that IRA is putting itself in the battlefield with the insurance industry, to ensure that we all comply with the standard. So thank you very much, everyone. I thank you for the participation, and you are welcome to join the working party. You can always reach out to me, and we'll see how we can help each other. For future webinars, we'll alert you. One of them would be engaging with other stakeholders, example, NSC, CMA, and AKI for future webinars, and also we'll be organizing workshops just to help people understand the cracks of the standard. So thank you very much, everyone. And thank you, Nikhil.
Thank you.
So I think we can end it there. So bye, everyone.